Hello and welcome to everyone joining live today, and also to those who will be watching the replay as we send out the recording. My name is Nande Boss, and I will be the program director for the 1 hour that we have together. So thank you for honoring the invitation. A couple of things to note: the information provided on this webinar is for information purposes only and does not constitute an offer, solicitation, or recommendation of any investment product or service. Statements made in this webinar may contain forward-looking expectations, which may be based on the current views of GraySwan and those of the speaker. As always, please bear in mind that investments may go up or down and should always be considered within the context of each investor's personal circumstance and with the understanding of the risks involved. We do encourage professional advice, seeking of professional advice when considering your overall investment strategies and what is discussed today. We're very honored to have two experienced gentlemen presenting today. Our range of SCI GraySwan unit trusts are co-managed by Gregor Thron and Duncan Thron, who are here today. They have worked together for an excess of 19 years as a dynamic and cohesive decision-making unit. Greg is here as Chief Investment Officer. He leads the investment team with regards to investment strategy, asset allocation, and investment manager research. Gregor has 19 years investment experience, of which 14 years is as an investment consultant and wealth manager, and 5 years of that in offshore alternative investment management. He also leads our highly experienced investment team who join us in the virtual room today. As co-portfolio manager to our range of unit trusts, Duncan has consulted to and managed many of the largest and most prestigious institutional investors' monies in South Africa. He has 24 years investment experience, of which 19 years is as an investment consultant and wealth manager, and 5 years of which in offshore alternative investment management. So we're very privileged and honored to hear from the two gentlemen today. And before I invite Duncan to give us a macro overview, I just want to get a sense and feel of our audience here today, where you're at. And so I'm gonna put up a poll, and I'm going to encourage that we participate. So that should be on your screen right now. Can you outline your view of the markets over the next 12 months? So there are 4 options for you to select from. Are you pessimistic? Are you cautious? Are you cautiously optimistic? Or are you optimistic? I see that you guys are participating right there, and I'm going to share that, and maybe Duncan, you can even speak to that. I wonder what the people feel today. It's great. It's good.
Thank you, Nanda. I can see it's quite a volatile show, up and down, like the markets.
I'm going to share results. Can you see the results there? Wow.
I can see emotions running high. Yeah, not as unexpected. I think most of the investors are cautious and perhaps cautiously optimistic, thinking that potentially we have hit a bottom and markets can recover from here. So it forms a good base for the rest of our presentation, indeed.
Great stuff. Take it away, Duncan. Thank you.
Nando, thank you for that introduction. And I just realized, Greg, you and I have been together for close on 20 years. So soon we're going to have to celebrate. And I also realized that as the younger brother, he's actually overtaken me as our Chief Investment Officer. I have to say that Greg's really been instrumental, especially the last 3 years since we've changed our investment process. And he'll really allude to what we've changed, how we've changed, and the results. As a start, what I'd like to do is just to give you a bit of a macro backdrop with some insights into what we're thinking, but I'm going to leave the show in terms of our views and portfolio construction to Greg right at the end. Let's just see if we can get the There we go. So this first slide kind of summarizes how we feel. It's like the wild, wild west out there. And the movie with Clint Eastwood is one of my favorites in The Good, the Bad, and the Ugly. Also summarizes how I think most investors feel. What I'm going to do today is I'm going to start out with the ugly, then move to the bad, show you some opportunities, and really leave the good stuff over to Greg, which is really the great results which we've demonstrated across our range of unit trusts now since inception, which is just over 5 years. And it just shows you how time has flown, where our unit trusts have now all outperformed our peers and at lower fees, most importantly. And over the last 3 years, since we've enhanced our investment process to be more active, to make smaller tilts, to hedge more dynamically, you would have seen the results have now been top quartile over the last 12 months, 24 months, and 36 months. So very pleased with those results. And Greg will cover all the good stuff towards the end of the presentation. So let's start out with yet another surprise. As you know, our business's name is GraySwan. There are black swans in the market, and black swans are those unpredictable events that typically has an adverse consequence on your investment portfolios. And what have we just seen again this year? I mean, every December we go on holiday and we take a break and a rest, and it's kind of clockwork. We come back and then we're in for another surprise. And the markets have just become more and more volatile every single year. So the days of investment managers just using a buy and hold strategy are over. You have to be active. You know, across our portfolios, we look at the markets early in the morning, during the day when we actually trade around 12 o'clock, and then also late at night, 7, 8 o'clock at night, because the markets move so quickly on emotion, on sentiment, on tweets, on sudden news, and we've got to be ready. But if you just look at the first 9 months of this year, you can see there wasn't really places to hide. I mean, even, you know, an asset like gold that typically does well when markets become nervous, and especially when inflation is rampant, gold is down 10% in dollar terms. World equity markets are down 25%. Very surprisingly, bonds are down 25%. And I'll just show you what a poor beginning of the year it's been for bond markets. I mean, normally bonds are a great diversifier for investors, especially offshore bonds. But this time around, it's really had a dismal first start to the year. And then the NASDAQ, you know, the favored tech stock industry that's been the darling of the exchange for more than a decade, you know, down 30% and more. And of course, for all the youngsters out there or the real risk takers that's been in the crypto market, the Bitcoin's down 45 to 50%. And Bitcoin has been the best cryptocurrency out there. If you compare that to other cryptocurrencies, you know, most of the market have been decimated. They're down 85 to 95%. So it's really been hard. And if you look at the bottom of that slide, you can see one of the drivers have been interest rates. And interest rates have started moving up for the first time in more than a decade. Now, there has really been only two places to hide, and that's been if you were in the dollar, which has been exceptionally strong, and then also oil. And as we know, the Russian crisis and the Ukraine war has just resulted in commodity prices such as oil going through the roof. It has come off its highs, around below $90 for Brent and crude oil. But those have been the places to hide. And of course, cash, you know, is always king when the markets lose. Now, what's been painful for South African investors are like, you know, the darling of our stock exchange would be Naspers and Tencent for more than a decade. And Tencent has since January of last year wiped out 65% of its value, 2/3 of its value. It's been the largest stock on the Hang Seng stock exchange, nearly hitting about $1 billion or $1 trillion in market capitalization, having now fallen to around $300 million market capitalization. So decimated, and most South Africans have got a large chunk of their local stock portfolios in Tencent and even offshore stock portfolios. So it's really hurt. And it just shows you that nothing just goes up forever. Even the best companies in the world goes through volatile times like we've seen for Tencent. And on the right-hand side, you can just see like a market like China that's had a really good run. A lot of investment managers have started new China funds, and fund of funds. And if you just look at that market, also down more than 30%. So it's really been hard. And the Chinese market has gone nowhere in a decade. So another lost decade for another market. And then, investors always look at bonds and say, but bonds are a low risk asset and should diversify our portfolios. And quite scary if you just follow what's happened in the UK over the last 2 weeks. Some stimulus was pushed into the market and retracted very, very quickly when the UK gilt markets reacted negatively and yields just spiked and the pound plummeted. The market basically just said that you can't put stimulus into the market. You've got to be cautious. And a lot of UK pension funds were in trouble because they were sitting with a lot of bonds and the government had to intervene and buy back some of those bonds. So just these are the signs of troubling times. And I can recall when Greg and I managed money out of New York in 2008, when Bear Stearns went bang and Lehman Brothers, suddenly you started seeing very ominous signs. And thereafter, we had that market crash of more than 50%. So we're still seeing a lot of ominous signs and some scary signs, like we just saw in the UK bond market. Now, where is the free lunch then? And here you can see that government bonds, offshore global government bonds, with it being down 25%, it's the fourth worst year, across 3 or 4 centuries, going back to the 1700s. You can just look at that. End of the US Civil War and South Sea bubble. And these are all well handled in the history books. But now 19.33% down. If you look on the right-hand side bottom, the combination of 60% global equities and 40% bonds. And that is kind of the go-to portfolio. It's been what they call the golden portfolio over many decades. For a moderate risk profile portfolio and a client that really wants to be diversified, you put 60% in global equities and 40% in bonds. And most of the times you'll see a positive result over any calendar year. Like you can see there, most of the numbers are green. Here and there's a red. But suddenly, year-to-date 2022, down 19.3. And if you go and compare that to history, well, you're going to have to go back to 1937, where that combination lost 20.7%, and 1931, when that combination lost 27.3%. So it hasn't been easy, even for investors that's trying to protect by using bonds. Now, what's driving all of this? And as we know, it's inflation. That's one of the major concerns. And if you look at the world economy on a weighted base, on the left-hand side, you can see that inflation is now in excess of 10% and still slowly creeping up. We just saw the UK numbers coming out this morning, and it's even up further, also beyond 10%. Our inflation numbers more or less 7.5%. And emerging markets are keeping up better than developed markets across the board. So, I always say, being located here in South Africa is not such a bad thing. Our currency has actually been stronger than the pound versus the dollar. Our stock market's been better than the UK stock market. Inflation's lower. It's a warmer place. I think we're far away from the war. So, South Africa's not a bad place to be in. On the right-hand side, you can see what scared the markets. There's 2 components to CPI. And the core CPI number is the one that scared the markets, that has kept going up because the rental component of core CPI continues to go up. And that spooked the market. And of course, the other driving force of the concern is, are we in a recession? Now, the technical definition of a recession is really that if global GDP contracts for 2 consecutive quarters, then we are in a recession. And that has happened. But there are many other factors that one should take into account. One of the indicators on the left here is if you take the difference between the American 2-year bond and the 10-year bond, once that ratio goes into negative territory, typically one runs into a recession, not too long thereafter. And on the right-hand side, you can see, if you look at the markets and the expectations, we're now at 75 to 80% expectation that we are in a recession already. So the other concern is the US dollar. It's been exceptionally strong. And if you look at history, when the dollar becomes too strong, it acts as a wrecking ball. And normally thereafter, we have some form of a crisis because everything's priced in dollars. and things just get more and more expensive. Like, for example, commodities are priced in dollars. American companies try to export their products, and if it's in dollars and other currencies are weakening, they can't sell those products at those nice high margins. That puts pressure on their earnings, and finally the stock prices comes down. So we've got to be very careful about this strong dollar, and we're hoping that inflation will subside in the next 6 months, will just start lowering, so will interest rates, and then the dollar should weaken. So it's not a no-brainer just to take your money overseas and put it in dollars. And Greg will show you later that we follow a very active hedging process when it comes to our clients' money, that we don't just have a one-way bet in terms of foreign currency. Now, I think the one thing I have to remind all investors that what we're seeing here, it's happened before. And we've lived through this. I mean, I've lived through this for 25 years. It just never changes. The markets are always volatile. It's like the pendulum swings from left to right. And it just depends on how far the pendulum swings. And if it swings too far in one direction, there's always opportunities. Here I've just shown you the American stock market, the S&P 500. And you can see yet again, we're in that 25% drawdown territory where it's been on many, many occasions. The question is it going to bounce from here, or can we expect further losses? And what you always have to also remind is that, there's always this tug of war between the bulls and the bears. And we're really seeing it at the market at this point in time. We follow the market every night, and there are days when this market moves 5% in a day. But finally, over time, if you're a long-term investor, the bulls beat the bears. And you can just see, there I'll show you the average bull market is about 4 years. And then the right-hand bottom, you can see the average bear market is about just under a year. I have to say that a bear market in a recession is about 2 years longer. So you have to take that into mind. But on average, a bear market's just under a year. And a bull market on average gives you more than 100%. And a bear market on average, you drop about 31. We're down about 25 at this point in time. But if we are in a recession or moving into a recession, that number could go down by a little further. And when the market drops, let's say 20%, then on average, looking at history, investors that's got into the market at that point in time did really, really well. But the markets do not always behave exactly the same as history. It rhymes, but always somewhat different. And here you can just see, if you entered the S&P 500 stock market, really when the market hits a bear market, so meaning it's lost 20%, well, 12 months thereafter, on average, you're up about 22.7%. So it is a time that you've got to start thinking about moving to the market. And at this point in time, as you can see from this graph, and this is just one market, the S&P 500 is much cheaper. If you look at that line, you look at those green dotted lines across the screen, that middle one kind of shows you the average valuation over the long term. And you can see just end of last year how expensive the markets were. And now that it's come down, it's slightly below average. So one can say, potentially it is a time to start moving into the market. And many analysts, I've seen so much research in the last month or two, and this is just one, they try to go and match what's happened right now to what's happened in history and try and move forward on that same base. On the left-hand side, you can see, if you compare what we've currently experienced versus 1974, 1975, well, it's kind of a similar scenario. And then if history rhymes and repeats itself, well, we should see a strong bounce. On the right-hand side, you just look at moving averages, and it kind of shows you that we on that average line. And if, again, history repeats and rhymes, we should move upwards. But I think one of the signs that worries us a bit, which tells us it's not as easy as that, are these intraday moves that we've seen in the market. And this is, if cast your eye to the 13th of October, this was literally last week. And we were trading on that day and that night. And when the markets opened, it was down about 3 or 4%. And when the markets closed, it was up. And the difference was nearly 4 to 5%. And those big intraday swings typically happens in bear markets. And what we've seen is that is for us more an indicator that this bear market can be a little longer than what it is currently. If you go and look at history, and let's just look at the bottom part of this slide, then you will see that the average of all the big drawdowns we've seen in history looks quite similar to what we see now from January to August to September. And if history repeats itself, in fact, the market can go down a little further. And what's going to drive the market? Well, if earnings do not hold up, we can see some further downside. And that's really the proof's in the pudding, especially this week with a lot of earnings coming out again. The banks have been strong so far, but we're waiting for the companies. I mean, you saw FedEx literally about a month ago losing a lot of value just on a very glim view of the economy going forward. And most investors are asking the big question, when is the Fed going to pivot? And pivot just means when they change their stance and they're going to stop hiking interest rates. And it's kind of as if investors are thinking, as soon as that stops, the market will run. But if you look at history on the right-hand side, well, even when the Fed pivots, when it stops hiking interest rates, it still takes a little bit of time before the market really recovers. And here's some of the, I'm going from the ugly to the bad, and here's South Africa. Well, we haven't lost as much as offshore markets. We've actually been quite resilient. But what it shows here is that if the market drops by more than 20%, if you invest on average 12 months later, you're up with a very, very strong return, 20 to 60%. And our equity valuations are also now quite cheap. I think the best news for investors at this point in time are bond markets, and Greg's really going to talk to those. We've got healthy allocations to our local bonds because they offer a very high real return compared to developed markets and compared to emerging markets, you know, of the highest real returns. You can invest today and get about 10.8% in a 10-year government bond. And with inflation at 7.5%, that is a really handy return. And I think the asymmetry of our bonds is what really makes it attractive. For example, if interest rates increase over the next year from where it is currently, you will still get a 4.7% return. If interest rates increases by 2%, so quite a glim scenario, well, you'll barely lose money. You'll kind of be flat. If interest rates decrease from here, you'll make a 17% return. And if it decreases by 2%, you'll make a 24% return. So for us, it's like, if you have that asymmetry that you can really gain 17 if rates decrease by 1, and maybe like 5 if it increases by 1, a kind of a cash return, I think that's quite a good investment. So even in our aggressive portfolios, we hold healthy allocations. So without giving too much away, because Greg's going to talk to the portfolio positioning and the performance and everything, I think the message from us is just that it's still not a time to be brave. We've got to start nibbling in equity markets, and cautiously so. So back to the poll that Nande raised in the beginning, I think we kind of share the sentiment that we still have to be cautious, but we are optimistic, or cautiously optimistic, because there are some opportunities. And at the end of the day, that a graph on the right-hand side is really just depicts how we view the investment world. And it's that for our clients, we've got to protect their money, because if you lose money, you've got to make up more to get back into the position where you are. I mean, look at that bar. If you lose 20, like where the average equity market is down now, you've got to make up 25 to be where you are. So it's always a longer road back. And for us, it's about protecting capital and then participating adequately in the upside. We're not greedy, so maybe we'll miss on the upside, but for us, it's key just to have a balanced approach, protect on the downside, participate as much as possible on the upside. So that is the summary from my side. I think before we hand over to Greg, there is another poll that we're going to bring up. So I'm going to ask my team. This is poll 2. And we're going to give you the opportunity to participate. And then, Greg, I'm going to hand it over to you, and then we'll take questions towards the end of the presentation.
Thank you, Duncan. Let me just share my screen here. There we go. Just to confirm whether you're able to see my screen.
Yes, we are. Thank you, Greg.
Thank you. Morning, everyone. So while the poll's ongoing, I'll just wait for that to finish there. Just looking at the poll looks quite interesting. Comfortable that I'm well diversified, staying the course. That's sort of what the poll's saying at the moment. And it's exactly the right positioning you need to have in this environment. It's exactly where we are. It's all about being comfortable, being diversified. I think diversification is key in this environment. And that means holding various asset classes, holding some short duration assets, holding long duration assets, specifically in the local market where you're holding long duration bonds, hold offshore cash exposures to give you some diversification there. And then also hold assets such as gold, because it will rally in certain circumstances where you need to diversify your portfolio. So good to see that the clients of GraySwan or people on the forum today just feeling comfortable where they are and quite optimistic. So very much where we are. So let's run into just giving you a broad overview of the range of funds. Then I'll just quickly speak about the fees within our fund structures. Where are they relative to the markets? And then speak about the performance of the funds and really outlining the macro view which Duncan spoken about and how are we positioned at the moment and what are we looking for and where are we looking for opportunities? Because there's always opportunities, you just need to look. So this slide just shows you the range of funds. We've got the cautious fund of fund, moderate fund of fund, and aggressive fund of fund. Those ranges in terms of growth assets, typically the cautious fund would hold up to 40% growth assets, the moderate between 40 and 60% growth assets, and the aggressive up to 85. And then we also launched our flexible fund. That was in this year during the May of 2022. And why did we launch that fund? It's really for investors which are not limited to Regulation 28 in terms of the offshore allowance and have discretionary money and wants to allocate more into our best investment views. So the Worldwide Flexible Fund is where we really would implement our best investment views in where we could hold 100% of our assets offshore or even 100% of our assets local, depending what our view on the currencies is and depending what our view on markets are. So that's the range of funds out there currently available to investors. And they're also available on various lists. So you can go to Allan Gray, Glacier, Momentum, 91, and you can see most of the funds that are listed on there. So they are accessible to our clients via the lists. Let's just start off looking at the performance of the fund. This is our cautious fund. This is relative to the multi-asset low equity peer group, meaning funds with typically not more than 40% growth assets exposures. And there you can see the fund performance over all periods outperforming the sector by quite meaningful outperformance, meaningful alpha. And then if you also look at where do we rank in our quartiles, so we've ranked in the first quartile over every single period. If you look at the 1 year rank, 15 out of 161 funds, 3 years, 18 out of 156 funds, and 20th out of 134 funds. I think important for our clients is to understand that we will not take outsized bets. It's not the way we manage portfolios. We shouldn't be number one in the category. It's not how we manage money. It's really to try and outperform consistently through the cycle. And that's where we believe a lot of alpha is generated over the long term. So very strong performance on the cautious fund of fund. If you look at the aggressive fund of fund, also ranking in that top quartile over periods as from inception, over the 3 years, over the 5 years, outperforming the peers, and then also ranking quite strongly over all periods. Importantly is that we did change some of our investment philosophy over the last 3 years, and that's really worked in this environment. So very strong performance, all of our fund of funds, looking at the cautious, the moderate, or the aggressive. Now, one of the questions we do get from clients are, you are a fund of fund and surely your fees must be higher because you're also investing into underlying funds. And here I've outlined our cautious fund, the TER or the expense ratio, and relative to, on the left-hand side, the multi-asset low equity. And there you can see we have outperform at lower fees. Fees makes a massive impact on performance over the long run. So it's critical to try and keep your fees as low as possible. We're constantly doing that, and I'll show you a slide over how we've been able to reduce our fees even further. Importantly, on the right-hand side, there is also, if you look at the multi-manager average, so funds out there which are also selecting underlying funds, typically those fees are higher than single funds, but we're not. We've been able to really drastically reduce our fees for all three of our unit trust funds. You're looking at the moderate fund, or you're looking at the aggressive fund, running at very low fees. This is just a slide over time, and I've used the aggressive fund as an example, just how our fees have come down over time. And you can see currently TERs at 1.27%, very much in line with the bottom quartile of the industry. And we're still aiming to reduce the fees. And how do we do this? That's the big question. Well, as Duncan mentioned, we've been in the markets for a long time. I've been in the markets for 19 years. And one of the things we have a firm belief in is that in certain asset classes, it's very hard to outperform the market. If you look at, do the research, very few active stock pickers are able to outperform global markets. Even in this environment where you expect active managers to do better, a lot of managers have struggled and not been able to outperform the market. So in various sectors of the market, we have a preference for passive investment vehicles where we can access the market at 10 basis points, for instance. And also, with our big institutional book, we get much lower fees, which then filters through to our retail clients. So that's also how we do that. I think the key here on the left-hand side is that on average, we're looking at 50% of the portfolio is invested in passive type of strategies and the other 50% in active type of strategies. Why is that? Because we have a strong view on asset allocation. We have a strong view on sort of opportunistic times where you could increase risk or decrease risk. And the last thing we want is have an active asset manager or stock picker in our portfolios where markets, our view is markets should rally 5 or 10%, and then the stock picker or the asset manager doesn't rally due to stock picks, and that takes away performance. So for us, it's about having passive exposures, knowing what the beta in the markets are, and then moving in and out of markets opportunistically when we can. On the fixed interest component of our funds, we do have more active managers there where they do actively asset allocate between inflation-linked bonds, property, nominals, up the duration curve and so forth. And there it does add value, we believe, to have some active asset managers in there. We on the equity side, we do have some exposure to actively asset stock pickers, but a big component is to passively manage funds. You look at our fees, which are bottom quartile, you still get exposure to some of the best managers in the country, some of the big brand managers, up to the boutiques such as Fairtree, through different types of strategies. So it's really, if you think about it, building a rugby team and then putting the best asset managers or funds in every single position. That's what we need to do. And then decide where is it worth paying to have active managers in there. And I'll give you some examples in terms of how we've actively picked managers during the cycle and how it's added value. Now, I've spoken about fees and how important fees are. Why are fees so important in this environment? Because we're sitting in an environment where, Duncan mentioned this, where South African bond yields are yielding close to 11%. Now, if we can buy South African nominal bonds for our clients or buy income assets for our clients and have low fees, then the income and the dividend yield would filter through to our clients, and that would help them if they are retired in their drawdown rates. So that's very important. So fees are critical in this environment, specifically where there's opportunities to take on longer duration in the fixed interest components and get high yield on there. So this comes back to the income yield. So if you look at our cautious fund, the moderate fund, the aggressive fund, and the flexible fund on a look-through basis, currently where we're standing today, what is the forecasted yield, meaning the income and dividend stream you're going to get in these portfolios on a gross basis where we are today. So the cautious fund 7.06, moderate fund 6.25, aggressive fund roughly 5.4, and flexible fund 4.8. Let's take the cautious fund as an example. So if you are a client that has a 5% drawdown rate on your living annuity and your yield is 7%, that means after fees, you can generate almost 5.7% of income. If you're drawing down 5%, it means that just the income stream in the fund is actually paying for your retirement drawdown rate. And that's critical. So that's how we manage these portfolios, really looking at where the opportunities are and how can we reduce fees to increase the income for our clients. So that's the one aspect of it, is reduce fees as much as you can, build a team of underlying funds which are actively managed or passively managed, reduce the cost of the fund. But the key for us is risk management, downside protection, what Duncan mentioned. And that's what we do as portfolio managers for our clients and for our funds. It's really trying to actively asset allocate our portfolios and our views, and then try and reduce risk in markets. And how have we done this? I'm going to skip over the slide. It's in the pack. It shows you the asset allocations as at end of September. It changes. It ranges from our cautious fund at some point this year at 30% growth assets, short duration. We've moved it up into 40%, but there's big ranges we're moving in terms of asset allocation on these funds. The bottom line is what you can see here is that we are still conservatively positioned in terms of an asset allocation perspective. So I've spoken about risk management and how have we done through the last year? If you look at our aggressive fund, our moderate fund, and our cautious fund, just relative to cash over the last year, cash up, which is Steffi institutional cash, 4.63%. We've been able to outperform cash during this environment where markets are down dramatically across the globe, where global bonds are down almost 20%, where it's been a very tough environment and only cash and gold really has sort of held up. In this environment, we've outperformed our peers quite dramatically. So a very strong period for us. And it's all about risk management for us. If you look at the year to date, so starting the year of 2022 to where we are today, is that our cautious funds flat, meaning we haven't lost money and you're still getting a 7% gross yield on the fund. So again, if you're drawing down only 5%, we haven't lost money on the fund and you're getting the 7% yield income, or let's call it 5.5% yield income after fees. So that's quite critical. So we've been able to perform very well in this environment. And remember, even if you look at our aggressive fund, where we could allocate up to 85% of our assets into growth assets, such as offshore property or global equities or local listed property, our fund's basically flat for the period. And how have we been able to do that? That's critical. It's risk management, it's diversification, but also looking for opportunities. This is our flexible fund. It doesn't have a 12-month track record, but it just gives you an indication of how this fund has performed during this period. Also, this fund does invest very aggressively at points in time, but we're up since inception 3.28%, outperforming almost every single asset class there is, except for US dollars or US dollar cash. So again, showing our risk management plays a role in terms of performance. So let's just reflect back to the start of 2022 and what was our views and how did we position portfolios accordingly? And then I'll run into what is our view currently, where the risks are, where's the opportunities, and what do we need to look forward from this point in view in time. So if you look on the left-hand side, you see Oprah Winfrey. My wife loves Oprah, and she always makes a joke about where Oprah comes on stage and then says, you get a car, and you get a car, and you get a car. And it's exactly what global central banks did during the COVID period. You get a stimulus check, and you get a stimulus check, and you get a stimulus check. And then central banks across the globe came out to the market saying that this is not going to cause inflation. It's going to be transitory. But in reality, it caused some of the biggest inflation we've seen in 50 or 60 years. And that was our view. Our view coming into 2022 is saying, look, the environment's changed. Inflation is going to be higher than the markets anticipated. Reserve banks will have to start hiking interest rates to curb inflation, and we are going to be positioned conservatively. How are we going to be positioned conservatively? Well, first you need to look at the yield curve. We want to be short duration so that if yields goes up or interest rates goes up, we don't lose money. So what did we want to do? We didn't want to hold long bonds or global government bonds in the offshore markets. We wanted to look for other opportunities. That was our view. Also, be careful of growth assets. Be careful of technology businesses, because those are very susceptible to interest rate hikes. And look for more conservatively typed asset classes. So that's what we did at the start of 2022. And on the right-hand side, we see there that the Fed will need great skill and good luck to bring down inflation without crashing the economy. And that is our concern at the moment. It's that crashing the economy, because inflation is so high, they will have to hike quite dramatically. I've spoken about bonds, and starting in 2022, we didn't want to hold long duration government bonds abroad because our view was that interest rates has to hike quite dramatically and you will lose a lot of money. So we weren't there. So we were conservatively positioned in that sense. And then the other thing is very critical. We spend a lot of time understanding currency movements. And this is the DXY, dollar, the dollar trade weighted index. And if you look at on the right bottom slide there, that slide shows you the interest rate differentials between developed markets and the US. And what does it mean? It just means the yield or the interest you're getting buying a US government bond versus other developed markets, such as Japan or such as Europe. And in cycles where the US Fed starts hiking interest rates quicker than other developed markets and the interest rate differential moves quicker, we see the dollar strengthening quite dramatically. Why? Because if you're sitting in Europe and you're getting 0 on a German government bond, and you can get 2 or 3% in a US government bond, what do? You sell your euros, you buy dollars, and you buy US government bonds. And these are the cycles you move through. So the dollar ran dramatically, and that was our view. So we increased our offshore exposures from where we were sitting in 2022 in our cautious fund, roughly 15%, up to 30%, a 15% move into the offshore markets. It's a dramatic move, but that was our view in terms of currencies. In terms of the currency, still where we are, we still think it's not the end of the dollar, not an environment where Europe's really struggling economically due to the increase in gas prices, the impact of that on the economy, and where the Fed has a very strong US economy looking at the labor market, and they can hike interest rates. So that's quite critical. So the start of this year, I mentioned we didn't want to hold long bonds. So what did we do? We went into the market and looked, saying, well, I don't want to hold long bonds in my offshore component, but what would typically outperform even cash in an environment where bond starts going up? Well, it should be value type orientated managers with hedged equity. And what did we do? We bought into Orbis Optimal, which is a hedged equity strategy with a value orientation. And there you can see Orbis Optimal up 18.54%, outperforming even dollar cash during this environment. That's one positioning we did. We've reduced that exposure and started buying long bonds of the offshore markets as US bond yields started moving to 4%. Because if we have some global systematic risk in the credit markets, you should see bond yields coming down, and that should give us protection again. So it's rotating between different asset classes during different environments. I've spoken about looking for opportunities. As a South Africa, this is the 10-year South African government bond. We've had yield spikes where the bond goes from, SA government bond goes from 9.10 to 10.20, 10.40 in a question of a week or two. These are opportunistic trading opportunities where we're sitting in short duration assets such as cash or floating rate notes, and then buying into South African nominal bonds as these yield spikes out. This slide shows you the movement of South African nominal bonds and inflation-linked bonds, which we also hold, and the difference in movement between them. And here you can clearly see where the yield, if you look at March of 2022, you had a rally of 6% in nominal bonds in a period of 2 weeks. And it's really these opportunistic times where we look to buy into the nominal bond market after a rally of 5-6%, take back some of those profits we've made and move more conservatively into cash type structures. The dollar, in terms of performance, if you look back at 2021, also, how did we do so well? Well, when in 2020, COVID hit and the rand depreciated to 18 rand to the dollar, we opted to hedge out 50% of our offshore currency exposures because our view was that the rand's blown out too far. If you have some liquidity coming back into the markets, if you have some normality in the market, you should see the rand strengthening quite dramatically. It did. We took profits on those positions, and then we increased offshore exposure even further from that point in time. I remember looking at MoneyWeb and some of the asset managers. I think the rand was trading at 12 rand 50, saying the rand could appreciate even further. Our view was that the US hiking interest rates quicker than the rest of the globe, you will have the dollar strengthening. And that's exactly what we did, increase that. Why is this important? And if you look at the rand versus the dollar, and you can see the slide, there's a big correlation between what happens with the rand, or rather what happens with the dollar will impact the rand. And that's what you've got to look at. If we look through the cycle forward from year on in, we need to start thinking, if the dollar starts depreciating, and at some point it will, which asset classes will do well? Because you can't just be sitting in dollars, because you will lose money from a South African perspective because the rand would start appreciating. So that's the view we need to start looking at. Then you have to ask yourself, when do we think this is going to happen? So that's quite critical. Also, what's important in terms of the current cycle, we've used currency hedging quite tactically around Fed meetings. Why? Because the market's looking for a pivot. I think the market's wrongly looking for a pivot at this point in time, but I can't go against the market. So what we're doing at certain pivotal points where if US inflation comes out, or where the Fed comes out in terms of their view on interest rates and whether they're going to hike interest rates, we do have some shorter term strategic currency hedging in place. Why do we do this? Because what we typically do in these environments, we would increase our offshore exposures, increase our offshore cash exposures, but then they hedge the currency. Because if the Fed starts indicating that they may pivot, you should see the currency strengthening quite dramatically, and those hedges would protect us. If the Fed is in an environment where they would hike even further than the markets anticipated, you should see global equity markets and local equity markets sell off. And that's the type of positioning where we do a lot of risk management on the fund to give us alpha. Looking forward, I've got 4 minutes really. As Duncan mentioned, I think the first worry in terms of 2022, where we started, was inflation. Now, I think inflation is no longer really the surprise factor that it was. We all know inflation is there. I still think inflation is going to be stickier than what the market's anticipating. And the Fed and central banks may keep interest rates higher for longer. That's the risk here. But I think we've looked past that. So we're at the end of inflation potentially. And if you look at just 2 indicators, you look at used car sales in the US on the left-hand side, and if you look at global freight costs, you can see most of these indicators have come down dramatically. So inflation is definitely slowing down. As Duncan mentioned, one of the big issues is shelter, which is almost a third of US core inflation, what the Fed looks at. And that will take time to move out of the inflation numbers. But we've hit inflation peak. That is our view. Our next worry is earnings, because we think earnings, the market's anticipating still too strong earnings. And that's the problem. And what this graph shows you is that as earnings moves over time, you would see stock market prices moving. So if your expectation is that earnings will come down in global markets because of higher interest rates, then you have to be a bit careful in terms of just holding equity market exposures. Now, in terms of earnings, it's important to think of what the Fed's going to do. So the US Federal Reserve will look at the economy. They will firstly look at inflation. They have to curb inflation. They said they're going to curb inflation, so they will keep on hiking interest rates. Then the next question is, can they keep on hiking interest rates? Well, if you look at unemployment in the US, the last time we've had such low unemployment numbers was in 1969. That means the US economy is very strong. You have almost full employment. That means the Fed can hike interest rates. That means the Fed can potentially keep interest rates higher for longer. What does that mean? It means that the consumer in the US is potentially going to start struggling. And what are we seeing already? Well, if you look on the left-hand side, which is personal savings rate, think back of that slide I showed you in terms of Oprah coming out, I give you a paycheck, I give you a paycheck, I give you a paycheck. You had massive stimulus in the market, and you had these very high personal savings rates in the US. Suddenly, personal savings rates has come down to levels we haven't seen since 2008. Then we start saying, well, US consumer don't have a lot of personal savings, so how are they going to consume, number one? Secondly, are they in potentially feeling some financial strain? And what do we look at? Look at US credit cards, consumer credit. You can see this massive increase in credit suddenly in the US market. With that, they've also bought homes where home prices were rallying 20%. They are levered. So be careful in this environment, because I think this cycle has to still play out. And if the consumer is really going to struggle, then that should filter through into the economy, and that should filter through into earnings at some point in time. This slide shows you market pivots. I've got 3 minutes left here. And the idea behind market pivot is the market's looking for the Fed to start cutting interest rates. Now, if you look back over 60 years of the Federal Reserve, and if you look at CPI, you look at Fed fund rates, you look at money supply, never in history has the Fed cut interest rates when they are this far behind the curve. When the gap between inflation and interest rates is this big, never. And the odds that they're doing at this point in time is low. We know that Fed chair said that they are going to hike interest rates and keep it up there to try and curb inflation. Now, this slide is interesting because what we need to look at is, where is the bottom of the market? Is it when the Fed starts pivoting, or do we need to wait a bit longer? It's to Duncan's point, we are cautiously optimistic, but we don't think it's the bottom of the market. Why? Because if you look back in history and look at the purple line here, the purple line shows you US unemployment. The gray shaded area shows you US recession. The black line down shows you the bottom of the market. What can you see? You can see that never in history have we hit the bottom of the market where US unemployment has been this low. Typically, what you need to start seeing, you need to start seeing interest rates increasing. You need to start seeing inflation coming down, and you need to start unemployment rising. We're not there yet. And that's why we think the pressure on earnings will still come through. And that's why we're still cautiously positioned. In terms of where's the opportunities, emerging markets. This slide shows you emerging markets versus the S&P 500. It's been a lost decade for emerging markets. If you look at Duncan showed those China slides, there's a lot of opportunities in those markets out there. Secondly, you need to look at the currency. If we get into a point where the DXY, the dollar, starts weakening at some point in time, if the Fed starts cutting interest rates, emerging markets does well. So there's a lot of opportunities. It's emerging markets trading very cheaply. This slide shows you 10-year rolling performance. You can see the JSE in brown, emerging markets in pink, and then you can see the S&P and MSCI World Global Markets. You can see the cycles which you run through. And you need to look back in time. The last lost decade for the US stock market was when the dollar was very weak. And what happened to emerging markets? Emerging markets did phenomenally well. So these are the cycles you need to start looking at. That's important. Secondly, what we're looking at is, where do we think earnings surprises, or where do we think the market's already pricing in a lot of bad earnings? And where's the market under-owned by institutional investors, and where are assets cheap? That's, I think, a safe place to be at this environment. And two of those sectors are real estate, US property, and basic materials. So we like offshore. We've increased our offshore property exposure now to roughly 5%. Why? We're getting yield. If we go into a global stagflation environment, property typically does well in that environment. And secondly, it's a hated asset class. The institutional market doesn't like it. And that's really where you need to start looking at basic materials. If you're looking at the local component of our equity exposures, we like holding Aussie 40, the Aussie 40 passive component, not cap switch, because we like a high allocation to basic materials at this environment. So that's it. To finish off my last slide, it's very hard to time the bottom of the market. As Duncan mentioned, if markets are down 20%, typically if you start buying in, you would do well over the next 12 to 24 months. It depends whether we hit a deep recession or not, but it is a good time to start buying in. And that's why we do hold equity exposure. That's why we do hold property exposures, because we think there's a big opportunity in there. It could go down further based on what happens with earnings and what happens with the Fed in this next cycle. We are cautious and we will look for opportunities to increase risk even further where we can. But this slide is a slide by M&G, and it shows you the zero line, shows you South African inflation. If you look on the left-hand side, and based on where equity valuations are, based on where government bond yields are trading, based on where SA property is trading at the moment, the outlook for these asset classes is that South African equity could yield you 11.4% above inflation in the next cycle. And if you think back of that slide I showed you in terms of emerging markets versus developed markets, it's been a horrific 10-year period for emerging markets, which includes South Africa. And in the next environment, you could do very well. So therefore, there's a lot of opportunities. South African government bonds, this is also why we don't have such big equity exposures, because we can get 11% yields on South African bonds at this point in time. And I think a lot of bad news is already priced into the markets. So we don't need to take on a lot of additional equity risk to try and get growth for our clients. So I think to finish off, it's a very tough macro environment. I don't think we're quite at the bottom of equity markets at this point in time. There's a lot of things that still need to play out. But there's opportunities. There's opportunities in South African bonds, specifically for South African investors. If you are drawing down money, you retired, you can get a nice yield on a look-through basis, and you can get exposure to assets which are priced very cheaply. And if it reprices and markets rallies, you can really make your assets grow in this environment. So I think what a good place to be in. And I think just to finalize here is, we really try and risk manage our portfolios quite well. We have shorter term positioning to try and manage risk for our clients, and we have shorter term times where we do increase risk quite dramatically and then take it off the table again. Because I think volatility will stay high in this environment where yields are high, and that actually provides opportunities. So to Duncan's point, you mentioned earlier, I think the age of just buying and holding assets in this environment is not the right strategy to follow. I think you need to be more active, you need to look for opportunities, and you need to tilt your portfolios more dynamically. And that's it from my side. Nandi, I don't know whether there's any questions from anyone on the call today.
Thank you. I think I speak on behalf of everyone here when I extend a word of thanks to both of you for quite a comprehensive overview and presentation. Yes, we do have time for questions, and I am going to I've got a couple of questions here, and if you still have a question in the audience, do type it in. And gentlemen, these aren't directed to anyone specifically, so as I just read them out, you can decide between the two of you who would take the question. So the first one is, the markets are down between 15% and 25% this year, but our funds at GraySwan are only down at a few percent. Please explain the tools that you use to protect your clients against such material losses.
Greg, I think you've summarized it quite well. So maybe from my perspective, I think the biggest one for us is looking at the currency. And Regulation 28 now allows us to take the currency up to 45%. It's not that we'll easily get there, but to Greg's point, we moved from a very underweight offshore currency allocation beginning of the year to quite a full allocation. Even the cautious funders, 25% offshore, moderates in excess of 30, the aggressives about 36. So we hedge the currency. We've been hedging it on a short-term base, sometimes for a week or two, but we're nearing that point where if the dollar still strengthens a little bit further, we can potentially put in like a 6 to 12 month hedge again, like we did in 2020, that worked really well for our clients. And the other ones are, things like gold and commodities. If the dollar is going to weaken, then gold should run. So whenever we see signs of that, we buy some more gold and opportunistically even take profits. And also when bond yields spike up too far, we sell them, we go and buy cash. Unfortunately, in the fund of funds, the cautious, moderate, and aggressive, the regulator only allows us to use currency hedging. And that's really why we started this new fund, the flexible fund. That's our unconstrained best investment views. And from a risk management perspective, how do we protect there? And how has that fund been the best performer year to date? It's because we can invest in anything. We can currency hedge, we can equity hedge, we can foreign equity hedge, we can buy futures, derivatives. There's so many more ways to skin a cat. And so I think from a risk management perspective, that's what that flexible fund really gives us, like an unconstrained ability to risk manage. So hopefully that summarizes, I think, what Greg's also alluded to in his presentation.
Great, thank you. I've got a couple of more questions before you end off. Graham is asking, what are your views on an escalating Russian war on investment funds?
Thank you, Graham. You always ask hard questions. I don't have a view on the war, Graham. It's impossible to call that. So let's feed this back into the global political environment and how do we need to be positioned? Is that suddenly we're moving from this environment of globalization to governments looking after themselves. You worry about a war between China and Thailand. You worry about these moves. So can I ever call that? No, it's physically impossible to do that. But what it means is that we just need to, within the portfolios, diversify ourselves, holding assets we can protect ourselves. That is dollars, holding dollar cash. We have to hold dollar cash. Even if it hurts at points in time, we have to hold some gold because that will do quite well in that environment. In terms of escalation in Europe, we're not very bullish on Europe. So we're trying to stay clear of Europe. It's more overweight into the US market at the moment because, to your question, is that the European war, it has lasted, I think, longer than most people anticipated. The impact on Europe it has had is massive and dramatic, and the impact it's going to have on those economies are dramatic. So I think what you need to do is look for other opportunities. I think even if that war goes on for longer, the US should do better because that economy is stronger. So what we need to do is look for opportunities in US markets, look for opportunities in emerging markets because they should not be affected that badly by the Ukraine war. So a long answer, but again, calling political risks almost impossible. I mean, just to add to that, when that war broke out, we immediately cut. Well, what we actually did when Russia started circling around Ukraine, we actually cut back our equity exposures. We increased our dollar exposures. So it's not that we just sit back and think nothing's going to happen. If we see a risk, we take some risk off the table because in this environment, uncertain environment, we just don't know.
No, Greg, maybe just to add on that, I mean, I recall, and there's a couple of clients on this call that, even on that day where we did not have discretion to move our clients' portfolios, where we act more in an advisory capacity, we contacted clients and had meetings. And on the day we started cutting back on equities and moved more towards cash, which in perfect hindsight, if you look at the equity markets versus cash, the last 9 months was the right decision. It wasn't bold, it was 3, 4, 5% that we cut. And that's how we control that risk.
Great. I'm going to take a couple more questions here from the audience. So there's a question here. How do you decide on a suitable benchmark for your fund performance?
Greg, you can take that one. Okay, let me take that one. I think the question was too hard, so Greg ran off.
I've got two more, but you can. How do we decide on a suitable benchmark for our funds?
I mean, for us, there's two benchmarks normally. I mean, the industry is peer orientated, so we know that we're always going to be measured versus the peers. So let's say, for example, the cautious unit trust is compared versus the entire universe of cautiously managed unit trusts, the moderate versus the entire universe of moderate unit trusts. And there's between 100 and 220 of these funds in each universe. So that is one of the measurements. But finally, according to the way we do our financial planning for our clients, we do use an inflation plus target for every single client. And that can range from inflation plus 2 to inflation plus 6. And it also depends on the year, how much time horizon they have. And so for the cautious fund, we try and get to that inflation plus 2% over 3-year rolling and to beat the peers. For the moderate one, again, inflationary target, inflation plus 4 and beat the peers, aggressive inflation plus 6 and beat the peers, and the same for flexible. But we know that sometimes it's just impossible to get to inflation plus 6. Nobody gets there. And then the question is, well, have we at least beaten the peers? And Greg showed you all those numbers, and we have.
Fantastic. I'm going to take one last one. Just looking at the time, this seems to be from someone who's invested with us. It says, my understanding of fund investments in general is that the extra layer of fees that the multi-manager charges, in addition to the underlying single managers, makes the product much more expensive than when I select a mix of single manager myself. But you've proven that your range of GraySwan's fund of funds are cheaper than selecting single managers myself. How do you manage to offer such low fees? I think that's a good question.
No, I mean, Greg alluded to it quite briefly, just in summary when he showed those slides. But I mean, the key points are just that, we use a higher location to tracker and low-cost funds, and we access those low-cost funds very cheaply. I mean, you can go and buy, let's say, a Satrix equity fund directly, but you're going to be paying more than 0.5% as a private client. We access those unit trusts at 0.1. So it's really at 20% of that cost as an example. Most of the other fund managers, we get institutional fees for our retail clients. And the derivatives we use, we obtain and access also at institutional rates. Because if you look at our big institutional clients, they are 3, 4, 5 billion in size, and we use a lot of derivatives and protection instruments. And then for our retail clients, we get it at the same low-cost institutional fee. And that's really how we get those fees so low. And like Greg showed you also, our drive is to continuously get those fees even lower. And the more the assets of our funds grow, the more economies of scale we're going to get, and the lower the fees will be. And we're passing that entire saving through to our clients. And that's really how we do it. And that's going to be the plan going forward as well.
I think to add to Duncan's point there, sorry, I went offline there for a second. It's my Bluetooth keyboard, which went haywire. To add to Duncan's point, I think what's interesting as well, what's changing, is that this environment of ETFs globally are opening up a whole new opportunity. And thereby, you can buy ETFs at very low fees. You can buy ETFs at 5 or 10 basis points. And the days of just giving you your money to a stock picker, I think you need to rethink that, because it's about accessing much bigger opportunities, much cheaper, and being able to buy ETFs in certain sectors. Like Graham asks, if you don't want to buy all Europe, you can buy a US ETF at 10 basis points. And it's so cheap. So that's also what we're trying to do is as the markets are evolving, to look for cheaper opportunities to access markets globally.
Yeah, and Greg, maybe one other example that I think is very important is how we use derivatives. For example, in the flexible fund, if we want to hold that bond position that Greg spoke about, you can get that 10.8 to 11% yield in bonds. The funds that you can go and buy, whether it's the Stanley bond or any other bond fund, they're still expensive. They cost in the region of 0.5 to 0.6%. And what we can do is we buy a bond future. at a zero management fee. We just pay a once-off stockbroker fee of like 5 basis points, nothing, 0.05 versus 50 basis points. And we buy that exposure just via using smart techniques. And really, if you look at our background, we used to manage offshore hedge fund monies out of New York and Switzerland. And we used a lot of derivatives at that point in time. And we're just applying the skills that we've learned across our career to get cheap and easy access to asset classes for our clients.
Fantastic. I think we've had a very informative hour, an equipped hour, if I'm going to be honest. And I'm very pleased to inform everyone that we will be sending out a recording. If we didn't get to, and I see there are a couple of questions now coming in, but if we didn't get to answer your questions live, we will be contacting you. I've got my colleague here who's jotted down all of the questions from today. So we'll send out the recording after this. Thank you so much for spending this hour with us. It wouldn't have been the same without you. Enjoy the rest of your day.